Well, welcome back to another episode of Lessons into Blessings. I'm your host, Tari Thomas. I am excited to bring the next guest on because we are going to be talking about, I believe, a sector of commercial real estate that's pretty ignored or just not talked about enough. It's not the sexy, but it's still making moves. And so I have with me on the show today, Drew Wahlgren, VP of Capital Markets for MAG Capital Partners. So if you guys can help me welcome Drew to the show.
Hey, Tari. Good to be
Hey, Drew,
here.
how's it going?
It's going great. Good to see you again. We got to meet recently, and I
Yeah,
appreciate you having me on your show.
yeah, no. So just to give an intro to people, so I met you at the Best Ever Conference, and there are a lot of different people in different sectors, different asset classes of commercial real estate that were there in the self-storage space, in industrial like yourself, in multifamily. And so we hear a lot about, in the real estate, and even just on our show, we talk a lot about the single family space. We talk a lot about the multifamily space, but we have never talked about industrial. And so I really wanted to give people just an insight into that market, insight into what that market is able to do for people who are passively investing in that space. And so this is somewhat of an intro, but enough for people to get a little bit dirty in that space. So thanks for joining me today. I appreciate it.
Yeah,
And also
absolutely.
congrats on the win, right? So the pitch, I loved it. The moment I talked to you, I liked a lot of what your company does. So really quickly, give me 30-second just intro on just MAG Capital Partners. So that way people have a little bit of background on that and who you're with before we jump right in.
Sure. Yeah, we're an investment firm, excuse me, focused on commercial real estate and really more specifically industrial real estate, single tenant industrial real estate with long-term triple net leases. And we've been doing that since 2015. And today we own and manage a little over 650 million in assets of primarily that exact kind of property. So we've really found a niche there, and we syndicate the equity and structure passive investments. So we have a group of investors who join us, and we invest all over the country. The unique thing about triple net real estate with a single tenant is it doesn't take a lot of day-to-day management. So we're very agnostic. We hold properties all over the country and really focus on the manufacturers of the world and of the country as tenants. And they're a great group. They're very steady, and they pay their rent every month. And it's a nice
No,
place
so,
to be.
no,
Yeah,
that's good. So let's back up because I know we're gonna dive into a little
we're
bit
gonna
about the
unpack
triple
it.
net leases, kind of what separates you guys. But as far as the industrial space, let's just give a quick intro on what the industrial asset class is for those that don't know. I think most people understand. Yep, we know what self storage is, we know what retail is, but what really is industrial? What does that space kind of contain?
Yeah, industrial's funny, and there's a reason why it's sort of it doesn't get a lot of attention or do, and a lot of people it sort of has a mystique to it, right? How do I invest in industrial real estate? And a big part of that is because you don't interact with industrial real estate every day, right? For
Right,
most people, hey, a multifamily, I mean, myself or someone I know has lived in an apartment building before, right? We've all had
right.
some exposure to that. We
Yep.
understand how it works, right? There's a leasing office, a management team, and they keep the building up and they charge rent. It's pretty simple. And even office, right? Hey, everyone understands who the tenants are there. Or self storage. Most people have at
Yep.
some point in their life held a storage unit. Retail, we interact with that every single day.
Exactly.
So all these things we interact with in our normal day-to-day lives. And then industrial real estate is, a lot of times it's on the other end of the other side of the train tracks, right? It's in some
Correct.
special zoning, and you just don't see it. And what's interesting is even if you do drive through these industrial zoned areas, it's hard to kind of decipher what's happening there. You drive
Exactly.
through, you see this big old building, and it's just a giant box, right? I call it a cereal box that's tipped on its side, right? It's just
Yeah.
this big flat box, and there might be one small sign that says LBZ Holdings or something like that. It's
Right.
really, it's very vague. It's hard to understand. And inside, you might have a warehouse and distribution center. You might have heavy manufacturing like a steel mill or something along that line. And
Yep.
you could also have, what we frequently deal with is a lot of light manufacturing, companies who are manufacturing widgets of any kind, whether it's plastic injection molding pieces. You could have, some kind of aluminum gears and sprockets being machined. A lot of these small parts that go into a larger assembly somewhere else are manufactured at a lot of these sites where they have specialties in certain types of manufacturing and have the equipment designed for a very niche type of engineered product.
Yeah.
Again, this isn't, something that we see in our daily lives because these companies are selling the product to another business, right?
Yeah.
It's B2B sales a lot of times. So we don't interact with these companies, let alone, the real estate that they occupy. And you might interact with the final product. You might have on your desk a little lamp there.
You don't know that where that development or manufacturing or whatever took place. Yeah.
Right, exactly. So, you're sitting in a room right now. The paint, the bricks, all of the construction material, all that gets manufactured somewhere. So it's kind of it's an envelope around our lives, and we just don't see it. We don't see all of that LED light fixture that might have a specialty chemical coating inside that protects the inner housing of that light fixture. And you go, well, you don't even think about that stuff. And what's interesting is, we live and breathe in this space. So we really get to know the companies that do that, what the application is there. And you go, wow, here's a company who does, $100 million, $500 million in revenue, whatever that is.
Yeah.
And it's a very large company and they're filling this need. They're servicing a whole bunch of different industries and other business clients of theirs. And they're quietly a profitable company that might employ, 150 people. And where do they exist? They exist in some piece of real estate, right? And it's, many of them are owner operators that own their own real estate, but a lot of them do rent. And a lot of them do decide to sell that real estate that they own and operate in and lease back. And that's how we acquire a lot of the properties that we get, which we can, again, unpack that in a little bit.
No, we will. So there's a couple metrics that I recently learned about. One of them is that industrial over some other asset classes like office, retail, self-storage, multifamily has had larger growth in those sectors over the past 5 years. And so I wanted to get a little bit into like why the explosive growth in the industrial space within the past 5 years or so. That's kind of outpaced some of the areas that everyone knows about, right?
I love the macro stuff. Yeah. And you can look back about 10 years, 10 to 12 years or so, really since after kind of that slow recovery after the financial crisis. And not that this was specifically a driver of it, but just around that time, we saw more and more companies moving to e-commerce sales, right?
Gotcha.
We saw more of that shift from brick and mortar, and it's just been a slow, consistent thing, right? Today we're buying more things online than we did in a brick and mortar building. So that's been, just a natural shift with the internet as it gets more sophisticated, as more retailers get more sophisticated and sell direct to consumers online. So with that has the need for industrial real estate to warehouse and distribute product from has grown gradually over time. And also about that same time, we've seen since about 2010 and on, we've actually seen a growth in US manufacturing jobs, which is a really cool thing. I mean, who doesn't want to see that, right? More jobs, we feel like, well, we saw 20 or now 30 and 40 years ago, a lot of the jobs leave the country due to globalization, cheap labor in Southeast Asia. And so a lot of that has been coming back just kind of slowly, to be honest. Since then. And really both of these trends.
It's getting incentivized, right? So
and these two trends have been accelerating a bit, but then COVID happened. And they both just shot up like crazy. So the first e-commerce, obviously everyone started buying everything online. All the retail businesses were closed, and you saw Amazon, Walmart, you name it, all the big retailers have a huge drive to expand their logistics footprint. They basically have a large hub and spoke system in order to get product out to the cities and down to the neighborhoods that people live so they can be, first to get product to your door, right? Amazon competes and has competed on, 2 days to your doorstep. Now I order something in the morning, it's there that afternoon. It's crazy. So
Yeah.
they have built this really strong supply chain system. And what's happened is that was a huge amount of growth right after COVID, and it's kind of leveled off, right?
Yeah.
They've built out quite a bit of that. And I think we're going to see incremental growth, nice, slow, steady growth over the next 10, 20 years. I can't imagine us buying less things online
Right.
over
Exactly.
time. I think most people agree with that. The other piece, though, is the manufacturing and how much those jobs that have been growing slowly over time. Now we're seeing a huge amount of manufacturing companies moving some of those operations back stateside.
Yeah.
And it's really for them is managing risk. They're saying,
Yeah.
look, if we need some of these critical pieces and they're tied up in a country like China that has, the Chinese Communist Party has, we've all seen it, right? Over the last few years, they've locked territories down, and now these companies are suffering, right? I can't
Yeah.
get that product that I need. And now I have an entire assembly line that's shut down based on the need of one product. The most well-known example of that is semiconductor chips at auto manufacturing
Yeah.
lines, right? Hey, I got this whole manufactured Ford F-250 and I can't drive it anywhere because it needs a chip, right? So
Exactly.
some of those critical pieces, companies are starting to say, okay, we need to diversify our supply chains and shorten some of those supply chains as well. And so some of that is, hey, I'm going to move some of these operations from China, spread it out to the Philippines, Singapore, other countries. And some of it is, hey, this is so critical that I can't even have any risk across the Pacific Ocean, right? I may have ports there shut down. I may have shipping lanes that get disrupted by a volcano or what have you. The West Coast ports, we've seen them get clogged about a year and a half ago, right?
Yeah.
Long Beach, hundreds of ships. So all that's been really disruptive. And so companies are trying to manage that risk by bringing a lot of those operations here. So great for America, good for jobs, and great for industrial real estate. There's a lot of people
absolutely.
building as much as they can, and still there's a huge amount of demand. So today, there's about a 3.4% national vacancy rate. So that's extremely tight. In the past, before COVID, we would look at markets and go, look, if they're under about 6 to 8% vacancy rate, that's pretty tight.
Yeah.
So considering the whole country is extremely tight there, in industrial real estate, it's absolutely been right up there with multifamily as some of the best asset classes.
Wow.
But
Okay. Yeah.
most investors have some exposure to, whether it's single family homes or multifamily, and no exposure to industrial because they don't understand how to get there.
Exactly.
How do I go and dive into this? And to tell you the truth, to get into it actively, it's a very institutional world that we're playing. We're in the sandbox alongside publicly traded REITs. The average purchase price is much higher than your average multifamily property, right?
Yeah.
You can go find a 10, 15 unit multifamily property and you might be paying, 150K a door, right? It's not going to be that much, but now you get up to these industrial properties and you start looking at, 5 million, usually kind of at a lower end, and all the way up to 25 million, 50, 100, 200 million, depending on how big you're getting. And it does get very institutional. It gets a little more sophisticated.
Yeah.
You are dealing with, instead of, Johnny Johnson over in apartment 101, it's a very, you can practically take a boilerplate lease from somewhere online and have them execute that. Now you're dealing with a much more sophisticated tenant, right? I have this corporate entity that has its own legal team. They do 300 million in revenue every year. They know exactly what they want and what they're doing. And not to say that anyone should be intimidated by that, but they're a sophisticated player and they're going to have their own legal teams, and not to say that they're going to try to screw anyone. It's just, it can be a little intimidating for your average retail investor.
No, that's understood. And I think one thing, and you tapped on a little bit with the vacancy rate, there are certain things that people understand from the multifamily side when they think about, okay, here's how I determine what's a good investment versus what's not a good investment, right? What's a good investment firm, what is not, right? Based upon maybe the location, right? Like we think, oh, multifamily, the Sun Belt is great, right? Or we think vacancy rates, we want, so many jobs are coming to this particular area. Here are the top XYZ markets, et cetera, right? What are those factors? If people are looking at industrial, what are the factors they should be looking at, kind of the key performance spaces that they should be looking at within within this sector?
Yeah, multifamily is so different, right? It's so much more focused. Your due diligence is going to be focused on the market heavily, right? You're going to look at what are the crime rates in this area? What are the population statistics doing? How are
Right,
they trending? How are jobs, trending up or down? All that's going to drive demand for rent, right?
right.
Demand for residents, or I should say, demand for housing, right? So all that's you're very heavily dependent on that. And remember, these are 12-month leases, right? So that can shift pretty dramatically in either direction, right? I could
Yeah,
get cut by that, or I could be make a lot of money being in the right market that has explosive growth, and now my
yeah.
rent went up
And
by
shift
30,
within a
50% on
year's
average.
period. Absolutely.
Right. So for us, we're dealing mostly longer term leases. And I'm going to focus a little bit on what we do more of, which is long term single tenant industrial real estate. And again, a lot of these properties are tenanted by manufacturing companies. Usually they've been around for 30, 50 plus years, 80, 100 years sometimes, right? And so they're typically signing long term leases with us, usually 15 or 20 years. So what we're focused on more is the risk around this tenant. We go, look, we have this long-term lease with them. That's great. The risk there is, do these guys get into trouble later on, right?
Right.
Could they file bankruptcy, right? Could they default on this lease? Because now I don't have one apartment out of 100 that I need to fill, and that might be a relatively easy task. Now I have, let's just say 200,000 square feet of industrial that's completely empty, right?
Yeah.
So you could see that rent is very binary. It's either 100% occupied or zero. And that can be a scary thought for a lot of people. So, we mitigate that risk quite a bit. And a lot of that is due diligence. So we focus so much on the credit risk of these tenants. And, that's probably another reason why you don't see a lot of individuals investing in the space. They have a hard time evaluating that credit risk and understanding
Yeah.
how that corresponds with, the cap rate of the property, what the value should be based on the credit strength or weakness of the tenant. And so all these things kind of, there are levers that you can pull in different directions and find different strategies. But at the end of the day, we're more focused on that because do I care what the crime rate is in a submarket that's mostly industrial, right?
Right. Right.
Probably not, right? I have a 20, I always tell people, look, these are, industrial
They're
zones.
usually not in the greatest places.
A lot of times they're not. Companies that make things set up shop in areas that tend to be more rough and tumble, and that
Right.
just sometimes follows an industrial zoned area, right?
Yeah.
There's less of a community presence, and at the end of the day, this is not a Lululemon, right?
Yeah.
I
Right.
don't rely on amazing demographics for this tenant to do well. At the end of the day,
Exactly.
hey, employees get there, they work, they create their product, they sell it, they turn a profit, they pay their rent. So it's a lot less focused on that and the swings, which is a good thing though, right? We have
Yeah.
this very steadiness out in front
Yep.
of us where we say, look, over the next 15, 20 years, we've done our due diligence. We sleep well at night because we really are comfortable with the credit strength of this tenant. And now this thing is very much on cruise control. Again, we're using long-term triple net leases. And for your listeners who don't know what this
Yep.
is,
I was just
we
gonna.
actually
Yeah.
yeah, we actually would use what we call an absolute triple net lease, which means that the tenant's responsible for everything, right? That includes insurance, maintenance, property taxes, utilities, and even the CapEx items, the big stuff, right? You have a single family home investment, obviously that's far from triple net or absolute triple net, but
Right.
imagine if they paid for everything. Well, you still kind of go, okay, they fix the holes in the walls, right? But who pays for the roof when it needs a replacement? That
Right.
even includes the roof and structure and HVAC systems. All that falls on the tenant in this lease structure. So in return, they pay a lower rent, right? That is sort of the trade-off there. So we're not putting aside reserves for those CapEx things, and we take a little bit lower rent. But the beautiful part is we don't have that risk now. We don't think, hey, in 2 years, I might have a $500,000 roof replacement, right?
Right. Right.
We're going to look at that roof, but I've seen even the best real estate investors and managers just get unlucky here and there, right? Hey, the roof looks like it's good for another 10 years. 2 years later, it's got leaks, it's got repairs needed.
Right.
And, that some of that stuff is a little bit of luck, right? And so we're completely insulated from those forces, from that, what I call operational risk, which is the day in and day out management of real estate. Now that's on them. So for us, hey, if we have a good quality tenant in place, they sign a 20-year lease and they're taking the expenses, it's very clear exactly what my cash flow is going to be. And that's the beautiful part. And we'll build in annual rent increases every
Yeah.
year, very modest, 2 to 3%, but we don't have that increase in inflationary effects on the expenses, right? So I've heard investors left and right talk about, oh, my multifamily property just got its property insurance, reassessed or
For
renewed,
sure. Yeah.
and the premiums just jumped way up. Well, of course, right? The cost of replacement has gone way up, labor, materials, everything else, just due to inflation. So, the insurance company's not making more money. They're just underwriting for, hey, what's it going to cost if this thing burns
Right.
down? So,
Now, so those are great questions. I mean, great, just insight, because you have a lot of those things that are dependent from an inflation standpoint that are now on the tenant. Is there any sort of consulting that you do to make it a win-win, right? So obviously a lot of falls on the tenant just to make sure that they're aware. Are they holding the right capital reserves to make sure that they're set for, if it's a 10, 15-year lease, we know lots of things break in that time period. How
yep.
do you kind of work with those tenants to make sure they're set up for success as well, as you guys move forward?
Yeah, good question. I mean, that's part of that credit analysis that we're doing. We're
Yeah,
going, look, number one, can these guys reliably pay rent? Right. And a lot of times you can look at some ratios. I mean, this is boiling it down a little bit. Obviously, there's,
yeah,
very nuanced, and probably thousands of factors and ratios you can look at. But one important one is, okay, what is their EBITDA, their earnings before interest, taxes, depreciation, amortization, right?
yeah,
If you're, for all my people out there who are not CPAs and accountants, but that's, a typical metric that you'll look at, right? Because that's really, your actual cash earnings, right? Before you take into account all these non-cash expenses like depreciation, right?
yeah,
So in any case, we'll look at EBITDA. Okay, how much is their EBITDA? Okay, it's 5 million a year. What's their rent obligations? 1 million a year. Okay, that's a pretty good ratio. They're covering it by 5 times, right? But you're going to look at, what's the expenses on the property, and at that rate, I mean, you're pretty well covered there. So usually you can kind of see, hey, this is a very profitable company. But if let's say their EBITDA was at 1.5 million and the rent was 1 million, that's slim. That's a
yeah,
company that's paying their rent by the skin of their teeth.
yeah.
And you go, wow, if they have some speed bumps that they hit, they might not be able to
They're
pay
going to be
rent.
set up for failure, essentially.
Right.
Yeah,
Right. Let alone some of the obligations that they have for the property, right? That lease and that triple net lease has obligation to them to take care of repairs, and manage some of these expenses. So yeah, if a big expense comes up, they may have to repave the parking lot, right? This is the level of responsibility that they
right,
have. So,
right.
again, that almost kind of falls right behind their rent obligations. So look, if they're covering rent, but it's barely any, yeah, we're not going to get comfortable there. We're not going to do that deal unless there's just a massive amount of a very high cap rate, or the basis on the real estate is extremely low. You have to have some other factor that's a huge draw to that investment. Otherwise, you're taking on a lot of risk, right?
Yeah, no, understood. Do you find, and you've kind of talked to it a little bit, just the type of tenants that you like to take on, but what's the right market? How do you determine what's in your portfolio?
Yeah.
Say,
Yep.
what's the right locations that I want to be focused on? Because these are where employers are kind of moving their business, they're moving their distributions, or supply chains, and then from there, what type of companies are you looking for specifically?
Yeah, in this sector, again, I don't want to concentrate solely on market and market growth. Really, you're going to look. I mean, we find a lot of these opportunities in the Midwest and the Rust
Yeah.
Belt.
Hmm.
If you look at population statistics, though, more people are moving away from the Rust Belt and towards the
Right.
Sun Belt, right? So, does that make this a bad investment, right? And no, it doesn't, right? There's still manufacturers that love that area. There's a lower cost of doing business there. There's a lower cost of labor there. And
Right.
maybe that's why some people are looking to go to the Sun Belt. Hey, I can get higher wages and higher income down here. But there's these companies, there's tens of thousands of them all over the Midwest. And there's a lot of manufacturing that happens up there. And the companies might be distributing a product all over the country, right, or the world. So they don't want to set up shop on Main and Main in,
For sure.
Dallas, Texas, right? They're going, hey, I got to pay a forklift driver, how much, in Iowa does he cost? Maybe it's $35,000 a year and you have a forklift driver. Maybe it's $60,000 a year if you're in LA County, right?
Right,
But the
right,
difference might be that $35,000 a year forklift driver in Iowa might be able to afford to buy his own house and support a
right.
family. And it's pretty remarkable. The cost of living changes quite a bit. So yeah, they like some of these areas for a reason, right? So population trends can shift, but you really have to look at the way these companies operate. And we're a little bit more agnostic, where we'll look at the opportunity first, the credit of the tenant, and the basis of the real estate. And
Yeah,
then you're doing your due diligence on the market, right? Of
yeah,
course, I don't want to own a property and feel like, hey, I got a great tenant with 20 years of lease term. Okay, that might sound great, but yeah, what if it is a town where the population is heavily declining, right? Hey, if this really is a town that's drying up, yeah, that's probably not great for, you know, for future asset
right,
value.
right,
We
right.
don't see that a ton, but it might also be that there's a lot of inventory out there, industrial real estate inventory. What's the vacancy rate? Hey, across the country it's great, but here there's about 15% vacancy. Wow, okay. There's a lot of empty real estate sitting around looking for a tenant. You do not want to be in a situation where you need a tenant and competing against that,
No,
right?
that's good right there. Yeah,
Yeah, and that's just, again, we're protecting downside risk, right? You go,
yeah.
well, I don't have to worry about that. I have a long-term tenant, until you do have a
Mm.
vacancy. So we really think about all those factors in the case of downside, right? In case of a tenant default, can I attract a tenant easily? Is there a lot
Yeah,
of demand here? So, there might be a town that, hey, population has grown at 2% a year, except it's Elkhart, Indiana, and it's one of the top manufacturing counties in the country, right?
right,
And you go,
right,
oh my gosh, the vacancy rate is 2% or something along that line, right?
right.
There's all kinds of demand for industrial real estate in that area from these companies that are growing. They need more space. Developers aren't building it fast enough, frankly. The cost of development today is prohibitive for a lot of developers too. They're saying, well, what's it going to cost me to build here? What am I going to be able to sell it for? This doesn't make sense. I'm going to wait until, interest rates come down or whatever that is. So there's a
And I
lot
can
of these.
imagine that just if they're, I mean, so for a lot of in the multifamily space, they say, well, there's going to be so much supply coming online. Is that something that you guys look at it? What's under construction that might be coming into that area that may soften the demand or anything like that?
A little bit. Obviously you want to look at what the brokers are seeing out there. That's always a great person to talk to, right? If you're kind of going, hey, how much visibility do I have in this market that I may not live in, right? And you talk to the brokers, they know exactly what's happening. Oh,
Right,
these guys are building over here. Lowe's is bringing in a warehouse, and that's going to serve, this entire region, and you
right,
get some of
right.
that out there, right?
Yeah,
But
because their third party suppliers are going to want to be close to them, right? Things like
right.
that. Hmm.
Right. So by and large, though, really, I mean, demand's outpacing supply, right? And
Yeah,
again,
for
some of
sure.
those macro factors we talked about, more
Yeah,
manufacturing
absolutely.
here. And a lot of the stuff that they're building, it's interesting. A lot of it is 500,000 square feet and up. It's the big, large warehouses. And so where we're investing is typically 80,000 square feet up to 500,000 square feet. It's in that kind of medium size
Yeah,
industrial real
nice. I
estate.
was gonna ask that very question. Where are you guys finding your niche, right? Where are you niching down?
Yeah, it's that size, B class, meaning 10 to 25 years old. Typically, a lot of these are, it could be a mix. Some are metal buildings, some are tilt wall construction, where they actually pour the concrete on the ground, make a wall, and tilt it up. If you've seen that with the big, 2x4s holding them up, so
No, I
you'll
have.
see that sometimes as
I
a
probably haven't paid attention, to be quite honest.
next
I have
time
a
you're
big
driving by.
industrial area that's not too far, maybe 15 miles from where I live, and you just try to get around it, right?
Yeah. Well,
Like you
it's
said,
heavier duty
it's,
construction. Yeah,
yeah,
it's heavier duty construction. You might see this now. You might be paying attention. You'll see
right,
what look
right.
like giant, 2x4s, or from a distance they look like toothpicks holding up this giant wall. And really, they tilt them up, and it's heavy duty construction. They use it for some of these very tall, clear height ceiling properties, and they
Wow.
like these because they're able to stack pallets very high. So anyway, that's just a type of construction. But yeah, typically we're buying stuff that's not, we're not developing a lot of new construction. We do a little bit, but most of this is, look, we're going to buy an existing asset that's considered B class, right? Not brand new. And frankly, we're able to get it at well below replacement cost, right?
Got
So
you.
even a metal building, there's nothing, like you said earlier, it's nothing sexy about it, right? It's usually metal framing with metal paneling, and a
Right.
lot of times even a metal roof as well. And the replacement cost is still at about $150 plus a square foot. We're typically buying these at anywhere from 40 to 90 bucks a foot, just depending
Nice.
on the market. And so there's a lot of security there. There's a lot of safety there. So yeah, nothing sexy. All the new industrial has like cool paint jobs with all this stuff, and it looks new and all of that. But there's a very high rent that has to be commanded to support the cost of that construction. That new tilt wall construction that I mentioned, 40-foot clear heights. I mean, we're talking about $300 plus per square foot to build, right?
Wow.
So what the rent going to look like? It's going to be very high, and it's only going to be able to be paid by some of the big blue chip companies, Amazons and Home
Right.
Depots and Walmarts of the world. And then what happens if you don't have them, right? You don't have a large group of companies out there that can support that kind of rent, that can pay that. So for us, we have this really wide net. Hey, we have a low basis here. We can, if we ever have a vacancy here, we can attract a tenant pretty easily because it serves the same purpose, right? These
Yeah.
are open floor plans, so you
Yeah.
can use it for warehousing, distribution, manufacturing, food packing, right? Food
Yeah.
processing. A lot of our tenants do that as well. So what they need is a big, large, open floor plan. And what's great about that from an investor standpoint is it's very versatile, right?
Yeah.
As long
Exactly.
as I'm keeping to that light manufacturing type of facility and not something super specialized like a steel foundry, right? I'm pretty limited if I have a steel foundry and it goes vacant. Well, who's my next tenant? It better be a steel foundry. so that's what we like, is that very versatile, four walls and a roof kind of real estate.
Cool. Now, so that's good. So now to kind of give passive investors a little bit of a look into, hey, if I were to start, investing in this space, what would that look like? We know some of the cash on cash returns and the multiples and all that stuff from the multifamily space. What are the typical indicators they should be looking at that's going to make sense to them, right? They may not understand everything, like, okay, great, this is industrial. What does those returns look like compared to a multifamily space? Is it similar? And how would they kind of what are the things that the returns that they were looking at within that space? And I know
Yeah.
that's varies from deal to deal, so you can't get
Oh
kind of
no.
too
We could summarize it. I mean, honestly, we have a very specific niche, and our returns are pretty consistently in a window, right? They're not wildly changing in projection from deal to deal, from
yeah,
investment to investment. So, but in general, yeah, if you're a passive investor looking, you want to get in this space, you want to talk to a sponsor who's reputable, has a lot of experience in the space.
yeah,
Hey, I've been in multifamily my entire career, and now I started syndicating some industrial deals. Do you want to be their guinea pig? I don't know, right? Maybe they're a very experienced operator and you feel comfortable. But in any case, yeah, you want to see, hey, someone who's got some experience in this sector, right? I mean, that's why you invest passively. And to me, a big part obviously is, hey, hands off, right? That's great, but I'm leveraging someone else's experience.
yeah,
So if I'm going
absolutely.
to use someone else's experience to manage my investment, then I certainly want that to be the best manager in that space, right?
Yeah,
Not someone who's new to it. So that being said, from a return snapshot, what we do, I mean, the advantages here are day one cash flow, right? When we invest in these, they're stabilized. We typically have a tenant in place signing a long-term lease at acquisition. And so what's great is you have 100% occupancy. And again, that
right,
triple net
right,
lease. So it's
right.
very much stabilized from day one. It's cash flowing from day one. Investors typically see between 7 and 8% in year one. And that's really nice to have, right? There's a lot
Yeah,
of value add investments that, you have to wait for. And typically there's some risk involved from day one until it starts cash flowing well, which might be, a couple of years down the road. A
yeah,
lot of things can go wrong in the meantime. So yeah, 7 to 8% cash flow. And then over time, we're increasing NOI of the property in a very set, predictable way, right? The rent's going up every year, 2 to
yeah,
3%. There's no expenses. So you can see what the net operating income does. And that's what the value is based on, right? The cap
Yeah.
rate's it's a function of the NOI, right? So, and over time, we're using fully amortized fixed rate debt. I should add, since that's the topic du jour, is what kind of financing are you using? What kind of risk
Right.
is it? We always use fixed rate debt, and that's just because we have this very predictable cash flow,
For
right?
sure.
Why ruin
Absolutely.
that? Why ruin that with a variable
Right.
rate debt, right?
Right. Right.
So yeah, even I mean, going back 7, 8 years, we've always used fixed rate debt. We like that predictability, and that gives us that. So over time, though, you're paying down debt. These aren't interest only loans that might be 2 or 3 years, and that might be appropriate for a different kind of investment. We like this, right?
For
It's a
sure.
very fundamentals based investing. And so over time, we're building a lot of value slowly and gradually, but starting at a very healthy cash flow. So investors see an increase in cash flow over time. And then when we exit, we typically sell with a lot of lease term left there. It's a very attractive asset to a buyer, 10 plus years of lease term, great tenant, all the financials are there. Great.
Yeah.
And at that point, investors, see the return back in profit. So typically, I mean, I'll just tell you historically, right? We've gone full cycle on 28 deals, and we've averaged about 20% annualized return, right? So pretty, and we're typically targeting mid to high teens, but
Yeah.
we've had some success that's kind of bumped up that average.
No, that's good. That's good. So I know we're almost to the end of our time, and this is Lessons into Blessings. So what are and maybe we'll hone it in to the industrial space. What are some mistakes that you made, maybe not that you've made, or maybe that your company's made, but mistakes that you see investors getting into when entering this space, and just some things that they should watch out for, pitfalls that they should watch out for as they start to investigate this space.
Yeah, yeah, it's a big part of it is, again, the single tenant risk, and you can almost apply that to retail even, right? You could find a
Right,
single tenant retail property with a long-term triple net lease, and the risk profile is kind of similar, right? It's all based around the credit of that tenant. So example that I love, a really good lesson that I've studied multiple examples of this, but Circle K, right? We all know the convenience store chain. In about 1990, they were the second biggest convenience store chain in the country,
yeah,
right? They were right behind 7-Eleven, I believe, was number one. So a huge chain. I think they had something like 4,600 locations, and investors love this, right? They say, hey, I got this convenience store. It's triple net.
yeah,
It's guaranteed. This lease is guaranteed by Circle K. What's more to do? I sit back and watch the checks hit my mailbox, and that's that,
right,
right?
right,
And yeah, that's the appeal. So the lesson here is that, shortly thereafter, or at about 1990, Circle K had a corporate guarantee on these leases that they signed with landlords, but Circle K filed Chapter 11 bankruptcy. They reorganized, right? So did that mean, obviously they're still around? They didn't liquidate, they didn't go away. But
right,
companies do this when they get over leveraged or in trouble, and all of a sudden they're going, look, we need to reorganize. And under the protection of the court, they can write off debts, but they can also reject a lease if they move out. So investors didn't realize, they said, I have a corporate guarantee, I'm safe. They didn't realize that the property that they bought
good,
and leased to Circle K was actually a dog, right? It was unprofitable location. And so when they got into trouble, yeah, they had hundreds of locations that they said, yeah, these are losing us money. We need to exit these leases. And under the protection of the court, they can. So huge lesson there, which is look at your site level financials. You may have the greatest company in the world. And we talk about this a lot. We think about this a lot while we're investing, which is, hey, Home Depot sounds great to have as a tenant. And maybe
right.
you do have a corporate, but if I don't have site level financials, it's a little scary, right? I don't know
Yeah,
actually what I'm getting here, right? This could be an unprofitable, bad
that's good.
location for them,
A
right?
little bit of risk management there, right?
Yeah, yeah. So site level financials, real important there. So we focus on that. I think, to me, that's a fascinating example. And the same thing happened another K store, Kmart, in 2002.
Very
Everyone
much
remembers that.
so. Sure. Yes.
Yeah, but same thing there. They closed about 300 locations, right? And so landlords there, they got hurt really badly because they thought they were safe and didn't realize that, hey, you can still get burned if they reorganize. And you might think, hey, they're still around. How can they do this? But that's Chapter 11 for you. So you really have to be aware of what you're holding
Yep.
And at the end of the day, that collateral is your real estate. So if you have a good basis, I'm sure a lot of those investors did just fine and re-tenanted the property. But you can't be above market and then expect to bring in a new tenant, because now it's going to be a little tough.
Right. No, that's understood. That's understood. Well, Drew, how can folks get in touch with you if they want to learn a little bit more about MAG Capital Partners or the industrial space? What's the best way for them to get in touch?
Yeah, they can go to our website, magcp.com, or you can email me, Drew, DREW, at magcp.com. Happy to discuss it with investors who are just wanting to learn more, want a little one-on-one time. I mean, a lot of what we do is just education. Again,
Yeah,
there's
no,
kind
that's
of
good.
there's a mystique around industrial real
For
estate. And
sure.
so we're happy to shed light on it. And thank you for having me on and
No
talking about
worries. I mean, I'm interested in the space, and definitely it's been a space that I'm just learning more and more about. I'm more, where tenants reside, but not tenants on this side of the space. So that's definitely more on the residential. So I'm definitely wanting to expose people to it more and just get more understanding about it. So thanks for just shedding the light that you shed, and we'll probably be in more conversations and talk more about. All that the industrial space and then Mad Capital Partners has to offer. So I appreciate it.
You got it. Thanks,
All
Tanya.
right. All right, guys. Till next time, stay blessed.